Hi, this is Mike Palmer with Group 1 Trading, and this is the Institute Volatility Sonar Report. We're here on a Friday after an unemployment number that was very positive for the market. We have the S&P 500 up about 15 points. What we see when we have the market rally, obviously we know, is the VIX will usually drop, and the VIX is now down into the 11 handle, which is pretty amazing. But what is an interesting trade that people have been entering into since the Brexit is the idea of playing the contango in the VIX futures itself. They buy the second month VIX future, they sell the front month VIX future, and as time passes or volatility goes down, you would expect that those futures to roll and that spread to get wider. So you'd buy the contango, that spread for somewhere around $1, and it would expand as volatility sort of rolled down the contango. That is, volatility went lower in the front month in the S&P 500 than it is in the second month. That's a very common trade, and as we have a day like this, we see those rolls even get wider. Right now, the September-August contango is trading about $2.50, which is a very big move. If you think about it, it was trading $1 only about a month ago. So that's a big move, and what you would see typically in that scenario is people enter into that contango trade, they buy an upside call in the VIX to hedge themselves. So they would buy today. They bought a big order of the August 29 calls. They paid a nickel for 25,000. The idea there is that they're long the September future, short the August future, looking for that spread to widen, and then they cover themselves by buying an upside call in case we have a big sell-off and that spread would go inverted, where they would pay $2.50 for it, but it would be trading $2.50 the other way. That is negative $2.50. In that scenario, people who enter into these contango trades like to buy upside calls to hedge themselves. So that what we saw today in the August 29 call buyer of 25,000. The only other trading I've seen today that is interesting too, with a roll down in the futures as volatility comes down, is you see a lot of people trade these 1x2s in the downside. Today we saw big traders of the 14-15 set 1x2. They buy the 15 put and sell 2 of the 14 puts. We also saw another one of the set 13-14 1x2 put. They buy the 14 put, sell the 13 puts twice. The idea there again is volatility will continue to roll down and drift down, and they would like to be short the 13 puts and long the 14 puts, and they think they can kind of take advantage of that contango roll down, quieting market with these 1x2 put spreads. So anyway, that's what's going on in the VIX in a generally quiet Friday after the unemployment number. This is Mike Palmer with Group 1 Trading. This is the Volatility Sonar Report.